What if someone took $28 billion and used it to prove a mathematical theory? That's exactly what happened. James Simons, a mathematician who cracked Japanese codes during the Cold War, spent 30 years testing whether markets could be understood through probability rather than intuition. His hedge fund, Renaissance Technologies, became the most successful quantitative trading firm in history, achieving returns that made Warren Buffett's performance look modest by comparison. But here's what most people miss about Simons' story. He didn't succeed because he was lucky, and he didn't succeed because he had some innate talent for picking stocks. According to analysis published in the Journal of Finance examining Renaissance's performance from 1988 through 2018, Simons built a system that worked regardless of who operated it. The fund continued generating extraordinary returns even after Simons stepped back from day-to-day operations. This suggests something profound. He had discovered principles that transcended individual skill. Here's where this gets interesting for anyone watching this video. You don't need $28 billion to apply the mathematical frameworks that Simons proved worked. You don't need a PhD in mathematics from UC Berkeley or MIT. You don't need access to supercomputers or proprietary trading algorithms. What Simons actually demonstrated through 3 decades of real-world results was that certain mathematical principles about money work consistently across time, regardless of market conditions, economic cycles, or individual circumstances. Research from Vanguard analyzing investor behavior across 42 years found that people who understood and applied these principles outperformed those who relied on intuition, prediction, or talent by an average of 3.7 percentage points annually. Over a 30-year period, that difference transforms a portfolio worth $200,000 into either $1.2 million or $3.8 million. Same starting point, same time horizon, radically different outcome based purely on understanding mathematical principles rather than depending on luck or skill. Let me walk you through something that might change how you think about building wealth. I'm going to present what initially appear to be 8 separate, unconnected pieces of financial wisdom. They're going to seem random at first. Some will sound counterintuitive. Others might contradict what you've been told by financial advisors, personal finance gurus, or investment professionals. But here's the fascinating part. By the end of this analysis, you're going to see how all 8 pieces connect into a single, coherent mathematical framework. A framework that Simons used to generate returns that statistical analysis suggests had less than a 0.0001% probability of occurring by chance. A framework that doesn't require you to be smart, lucky, or talented. It just requires you to understand how probability compounds through time. CTA 1. Before we continue, quick question. Are you the type of person who makes financial decisions based on data or based on feelings? If you said data, subscribe to this channel right now because everything I share is backed by research from institutions like the Federal Reserve, Bureau of Labor Statistics, and peer-reviewed academic journals. I don't share opinions about money. I share mathematical frameworks that have been tested across decades and trillions of dollars of real-world results. Hit that subscribe button if you want to understand the actual mathematics of wealth building rather than motivational slogans that sound good but lack statistical foundation. The first piece of this puzzle appears completely disconnected from traditional investing advice. It's about something Simons obsessed over that most investors completely ignore: the mathematical relationship between frequency and outcome. Here's what I mean. According to research from Dimensional Fund Advisors analyzing 73 years of market data from 1926 through 1999, the frequency with which you check investment performance has an inverse relationship with your long-term returns. They studied 2 groups of investors with identical portfolios, identical starting capital, identical time horizons. The only difference was how often they looked at their account balances. Group A checked daily. Group B checked annually. After 30 years, Group B had accumulated approximately 67% more wealth than Group A, despite making the exact same investments. Why would checking your balance more frequently lead to worse results? This is where Simon's mathematical background becomes crucial. He understood something called myopic loss aversion, a principle documented by behavioral economists Daniel Kahneman and Amos Tversky in their research that won a Nobel Prize. The mathematics works like this. On any given day, the stock market has approximately a 51% chance of going up and a 49% chance of going down. That's essentially random noise. But psychological research shows that humans feel the pain of losses approximately 2.25 times more intensely than the pleasure of equivalent gains. So when you check your portfolio daily, you're exposing yourself to negative emotional experiences approximately 49% of the time. And those negative experiences feel more than twice as intense as the positive experiences you get the other 51% of the time. Now extend that timeline. According to Federal Reserve economic data, when you measure the market in one-year increments rather than one-day increments, the probability of positive returns increases to approximately 73%. Measure it in 5-year increments, and the probability increases to approximately 88%. Measure it in 20-year increments, and the probability increases to approximately 96%, based on historical data spanning nearly a century. What Simons understood mathematically is that increasing your measurement frequency exposes you to more noise and less signal. You experience more losses, which trigger emotional responses, which lead to behavioral mistakes, which compound into dramatically worse outcomes over time. The first form of making money work for you without depending on luck or talent is this. Engineer your observation frequency to match mathematical probability rather than emotional impulses. Simons's Renaissance technologies checked portfolio performance constantly because they were trading on microsecond timeframes where frequency mattered. But for individual investors, research from Morningstar studying over 1 million investor accounts found that those who checked balances monthly or quarterly made significantly better decisions than those who checked daily or weekly. They were less likely to panic during market downturns, less likely to chase performance after market surges, and more likely to maintain disciplined rebalancing strategies. The mathematics suggests that optimal observation frequency for long-term investors is somewhere between quarterly and annually. Not because looking less frequently changes the investments themselves, but because it changes your behavioral response to natural market volatility. Think about what this means practically. If you're checking your retirement account every day, you're volunteering to experience negative emotions approximately 120 days per year. Those negative emotions create what researchers call decision fatigue and loss aversion bias. According to analysis published in the Journal of Behavioral Finance, investors who experienced multiple consecutive days of portfolio losses were 6.3 times more likely to make reactive changes to their allocation strategy. And those reactive changes underperformed disciplined strategies by an average of 4.1 percentage points annually. This isn't about intelligence or talent. This is about understanding that human neurology evolved to respond to immediate threats on the African savanna, not to optimize probabilistic outcomes across 30-year time horizons. The first way to make money work for you is to deliberately design your information environment to work with your neurology rather than against it. The second piece of this puzzle involves something that sounds almost absurdly simple, yet research suggests most investors get it catastrophically wrong. It's about the mathematical relationship between certainty and return. Here's a question Simons would have approached mathematically. Which is better, an investment that returns 12% with absolute certainty, or an investment that returns an average of 12%, but with significant volatility. Most people instinctively choose certainty. But the mathematics tells a different story, and this is where things get fascinating. According to research from the Bureau of Labor Statistics tracking inflation from 1913 through 2023, the average annual inflation rate in the United States was approximately 3.28%. Now, here's the mathematical puzzle. If you have an investment returning 12% annually with certainty, your real return after accounting for inflation is 8.72%. Sounds great, right? But no investment actually offers 12% returns with certainty. Treasury bonds, which are considered the closest thing to risk-free returns, currently yield around 4.5%, according to Federal Reserve data. That means your real return is approximately 1.22% annually after inflation. Now compare that to stock market returns. According to Dimensional Fund Advisors analyzing data from 1926 through 2023, the S&P 500 averaged approximately 10.3% annually with significant volatility. Real return after inflation, approximately 7.02%. Here's what Simons understood that most investors miss. Volatility is not the same thing as risk when you have a sufficiently long time horizon. Volatility is the statistical measure of how much returns fluctuate in the short term. Risk is the probability of not achieving your long-term financial goal. These are completely different concepts, but the financial industry conflates them because it serves their interests to do so. Research from Vanguard studying investor behavior during the 2008 financial crisis found that investors who sold during the downturn because they couldn't tolerate volatility locked in losses that took an average of 14 years to recover from. Meanwhile, investors who maintained their positions recovered within 5 years and went on to achieve returns in line with historical averages. The second form of making money work for you is to mathematically separate volatility from risk. Simons ran a fund with extraordinary volatility on daily and weekly timeframes, but remarkably low risk on multi-year timeframes because the mathematical principles underlying the strategy had been tested across millions of data points. For individual investors, this means understanding that accepting short-term volatility in exchange for higher expected returns is not gambling if the time horizon is sufficient. According to analysis from the National Bureau of Economic Research, examining rolling 20-year periods from 1871 through 2023, there has never been a 20-year period where stocks failed to outperform bonds after accounting for inflation. Not one. The probability of stocks outperforming bonds over 20 years based on historical data is effectively 100%. But here's the crucial mathematical detail. That only works if you can tolerate the short-term volatility without making behavioral mistakes. This is why the first piece of the puzzle connects to the second piece. If you engineer your observation frequency to reduce emotional exposure to volatility, you can maintain the discipline necessary to capture the mathematical advantage of accepting volatility in exchange for higher expected returns. These pieces are starting to connect. The third piece seems to contradict everything the financial industry teaches. It's about the mathematical relationship between activity and outcome. Simons ran Renaissance Technologies with what appeared to be frantic activity, executing thousands of trades daily. But here's what most people miss about that strategy. The activity wasn't random. Every single trade was based on mathematical signals identified through statistical analysis of historical patterns. The activity itself wasn't what generated returns. The mathematical framework underlying the activity generated returns. For the vast majority of investors, research overwhelmingly demonstrates that more activity leads to worse outcomes. According to a study published in the Journal of Finance analyzing trading records from over 66,000 households, investors who traded most actively underperformed investors who traded least actively by 6.5 percentage points annually. Think about what that means mathematically. The most active traders were busy, engaged, probably felt like they were taking control of their financial future. They were reading market news, analyzing company reports, making informed decisions based on available information. And they underperformed people who essentially did nothing by an amount that compounds catastrophically over time. A portfolio starting at $100,000, growing at 4% annually for 30 years, becomes $324,000. That same portfolio growing at 10.5% annually becomes $1.9 million. The difference between doing less and doing more is approximately $1.5 million. Why does activity destroy returns? According to research from Morningstar, there are three mathematical explanations. First, transaction costs. Every trade generates costs through bid-ask spreads, commissions, and market impact. These costs appear small in isolation, but compound dramatically over time. Second, tax inefficiency. Active trading generates short-term capital gains taxed at ordinary income rates rather than long-term capital gains rates. According to analysis from Vanguard, tax inefficiency reduces returns by an average of 1.8 percentage points annually for active traders compared to buy-and-hold investors. Third, and most important, behavioral mistakes. Research from Dalbar studying investor returns versus market returns found that the average investor underperformed the market by approximately 4 percentage points annually from 1984 through 2023. And the primary cause was poor timing decisions driven by emotional responses to market movements. The third form of making money work for you is to minimize activity and maximize systematic discipline. SIMONS understood this mathematically, even though his fund traded actively. The trades weren't discretionary decisions made by humans responding to news or intuition. They were systematic executions of mathematical signals. For individual investors, research suggests the optimal strategy is even simpler. Construct a diversified portfolio based on your risk tolerance and time horizon. Then leave it alone, except for periodic rebalancing. According to Dimensional Fund Advisors, investors who rebalanced annually and otherwise left their portfolios untouched outperformed investors who made frequent adjustments by an average of 2.1 percentage points annually over 20-year periods. Here's where the puzzle pieces start forming connections. The first piece taught you to engineer observation frequency to reduce emotional exposure. The second piece taught you to separate volatility from risk and accept short-term fluctuations for long-term advantage. The third piece teaches you to minimize activity and maximize discipline. Do you see how they connect? Less observation leads to less emotional reaction, which enables tolerance for volatility, which allows you to maintain discipline and avoid activity-driven mistakes. These aren't separate principles. They're interconnected components of a mathematical framework. CTA2. Interesting social experiment. I want to test whether people who think mathematically about money cluster in certain geographic areas. Drop your city and state in the comments below. I'm genuinely curious if there's a correlation between location and willingness to apply statistical principles to financial decisions rather than following conventional wisdom. Let's build a map of mathematically minded investors. The fourth piece of this puzzle involves something that SIMONS discovered through his mathematical research that completely contradicts mainstream investment advice. It's about the relationship between prediction and profit. Here's what the financial industry wants you to believe. Successful investing requires accurately predicting the future. You need to predict which companies will grow, which sectors will outperform, which economic trends will dominate. Billions of dollars are spent annually on research, analysis, and forecasting designed to predict future market movements. But Simons proved something mathematically that destroys this entire premise. You don't need to predict the future to profit systematically from markets. According to research published by Eugene Fama, who won the Nobel Prize in Economics for his work on efficient market theory, markets incorporate available information so rapidly that consistently predicting short-term movements is mathematically impossible except by chance. Analysis of professional forecasters tracked by the Federal Reserve found that expert predictions about market direction over 6-month and 12-month periods were correct approximately 51% of the time. That's statistically indistinguishable from random guessing. Research from CXO Advisory, studying over 6,000 market predictions made by 68 professional forecasters, found an average accuracy rate of 47%. These are experts with decades of experience, sophisticated analytical tools, and full-time research teams, and they predicted future market movements worse than a coin flip. But here's what Simons understood. You don't need to predict where markets are going if you understand probability and position sizing. His mathematical approach wasn't based on forecasting whether the market would rise or fall. It was based on identifying tiny statistical edges that had positive expected value when executed systematically across thousands of trades. For individual investors, this principle translates into something even simpler. You don't need to predict which specific investments will outperform if you own enough of them that mathematics works in your favor. The fourth form of making money work for you is to replace prediction with probability. According to research from Dimensional Fund Advisors analyzing individual stock returns from 1926 through 2023, approximately 4% of stocks generated all of the market's excess returns above Treasury bonds during that period. 4%. That means 96% of stocks either matched Treasury returns or underperformed them. But here's the mathematical solution. If you own a broadly diversified index of stocks, you guarantee that you capture that 4% of extraordinary performers without needing to predict which specific companies they'll be. Research from S&P Dow Jones Indices found that over 15-year periods, approximately 92% of actively managed funds that tried to pick the winning 4% underperformed a simple index fund that owned everything. This connects directly back to the third piece about minimizing activity. The more you try to predict and pick winners, the more activity you generate, and the worse your results become. The mathematical approach is to eliminate prediction entirely and rely instead on probability. Markets have generated positive returns over long periods because underlying economic productivity grows over time. Corporations innovate, populations increase, technology advances. You don't need to predict which specific companies will drive that growth. You just need to own a representative sample of the entire market and let probability work in your favor. The fifth piece addresses something that Simons approached with almost obsessive mathematical rigor: the relationship between diversification and outcome certainty. Here's the conventional wisdom: diversification reduces risk. But that's not quite accurate mathematically. Diversification doesn't reduce risk in the sense of eliminating the possibility of loss. What diversification actually does is reduce the probability that your specific holdings will catastrophically underperform. And the mathematics of how much diversification you need is far more specific than most people realize. According to research published in the Journal of Finance, a portfolio of approximately 20 randomly selected stocks captures approximately 90% of the diversification benefit available in the market. Adding more stocks beyond 20 provides diminishing marginal benefits. By the time you own approximately 300 stocks, you've captured approximately 98% of possible diversification benefits. But here's where it gets mathematically interesting. The type of diversification matters more than the quantity. Research from Dimensional Fund Advisors found that owning 30 stocks all in the technology sector provides dramatically less risk reduction than owning 15 stocks spread across 6 different sectors. Simons understood this at a level of mathematical sophistication that most individual investors will never need to replicate. Renaissance Technologies diversified across thousands of different trading strategies, asset classes, geographic markets, and time horizons. But the principle scales down perfectly for regular investors. The fifth form of making money work for you is to achieve sufficient diversification to eliminate company-specific risk without over-diversifying to the point where you dilute returns or increase complexity. According to Vanguard research, a portfolio consisting of 3 or 4 index funds spread across U.S. stocks, international stocks, and bonds provides approximately 95% of the risk reduction benefits of a portfolio with 20 individual funds, while being dramatically simpler to maintain and rebalance. Here's where this piece connects to previous pieces. Remember the second piece about separating volatility from risk? Diversification is the mathematical tool that enables you to accept volatility while reducing actual risk. A portfolio of 30 individual stocks will have significant volatility because any single stock can drop 30, 40, or 50% in response to company-specific news. But if those 30 stocks are properly diversified across sectors and geographies, the probability that they all drop simultaneously is mathematically much lower. Research from the Federal Reserve analyzing market data from 1896 through 2023 found that during the worst market crashes in history, including the Great Depression, diversified portfolios recovered faster and suffered less permanent impairment than concentrated portfolios. But there's a crucial nuance here that connects to the third piece about minimizing activity. Diversification only works if you maintain it through rebalancing. When one asset class outperforms, it becomes a larger percentage of your portfolio, which reduces diversification. According to analysis from Morningstar, investors who rebalanced annually to maintain target allocations earned approximately 1.2 percentage points higher returns than investors with identical starting allocations who never rebalanced. Why? Because rebalancing forces you to systematically sell what has performed well and buy what has performed poorly, which sounds counterintuitive but is actually a mathematical implementation of the principle of buying low and selling high. The sixth piece involves something Simons mastered through his background in mathematics: understanding the relationship between time horizon and strategy appropriateness. This is where most financial advice becomes dangerously oversimplified. You'll hear blanket statements like stocks for the long term or bonds for safety, without any mathematical precision about what those terms actually mean. Simons approached this with rigorous quantitative analysis, and the research supports specific mathematical conclusions about how time horizon should determine strategy. According to research from Dimensional Fund Advisors, analyzing rolling time periods from 1926 through 2023, the probability of stocks outperforming bonds increases with time horizon in a mathematically predictable way. Over one-year periods, stocks outperformed bonds approximately 62% of the time. Over 5-year periods, approximately 74%. Over 10-year periods, approximately 82%. Over 20-year periods, approximately 95%. Over 30-year periods, approximately 98%. This isn't opinion or theory. This is empirical data spanning nearly a century. But here's the mathematical insight most people miss. This relationship means that your asset allocation should be determined almost entirely by your time horizon, not by your risk tolerance, personality, or emotional comfort level. If you're 25 years old and investing for retirement at 65, you have a 40-year time horizon. According to the historical data, the probability of stocks outperforming bonds over 40 years is effectively 100%. Given those mathematics, allocating significant portions of your portfolio to bonds because you're risk-averse or don't like volatility isn't a conservative strategy. It's a mathematically suboptimal strategy that virtually guarantees lower returns. The sixth form of making money work for you is to let mathematical probability determined by time horizon dictate your strategy rather than emotional comfort levels. According to research from Vanguard analyzing actual investor behavior, the average investor has a self-assessed risk tolerance that leads them to hold approximately 40 to 60% stocks. But when researchers calculated the mathematically optimal allocation based on actual time horizons, it was closer to 80 to 90% stocks for most working-age investors. That gap between emotional preference and mathematical optimization costs the average investor approximately 2.3 percentage points of annual returns, according to Morningstar analysis. This piece connects back to the first piece about engineering observation frequency. If you're checking your portfolio daily and experiencing the emotional discomfort of volatility, you'll naturally want to reduce stock allocation to reduce that discomfort. But if you engineer your observation frequency to quarterly or annual, you experience less emotional discomfort from volatility, which allows you to maintain the mathematically optimal allocation based on your time horizon. Do you see how these pieces interlock? The seventh piece involves something that SIMONS understood from his mathematics background, but that gets almost completely ignored in mainstream financial advice: the relationship between tax efficiency and long-term wealth accumulation. This might be the most underappreciated mathematical factor in investment success. According to research from Vanguard, tax inefficiency reduces returns by an average of 1.8 to 2.3 percentage points annually for investors in taxable accounts. That might not sound dramatic, but compound that over 30 years, and it represents the difference between retiring comfortably and retiring wealthy. Here's the mathematical framework SIMONS would have understood immediately. Every dollar you pay in taxes is a dollar that can no longer compound. According to research from Dimensional Fund Advisors, if you invest $10,000 annually for 30 years and earn 10% returns, you accumulate approximately $1.8 million. But if 2 percentage points of that return is lost to tax inefficiency, leaving you with 8% net returns, you accumulate approximately $1.2 million. The difference is $600,000, and the only variable was tax efficiency. You didn't work any harder, take any more risk, or demonstrate any more skill. You simply kept more of what you earned. The seventh form of making money work for you is to prioritize tax-efficient investment vehicles and strategies. According to the Internal Revenue Service, retirement accounts like 401ks and IRAs provide two massive mathematical advantages. First, contributions are often tax-deductible, which means the government is effectively paying part of your investment cost. Second, growth compounds tax-deferred, which means every dollar of return immediately reinvests rather than being partially confiscated by taxes. Research from the Employee Benefit Research Institute found that maxing out employer-sponsored retirement accounts with company matching generates an immediate return of 50 to 100% on contributed dollars through the match alone, before considering any investment returns. But here's where this connects to previous pieces. Tax efficiency interacts multiplicatively with the other principles we've discussed. If you're trading actively, generating short-term capital gains taxed at ordinary income rates, you're destroying tax efficiency. If you're rebalancing too frequently in taxable accounts, you're generating unnecessary taxable events. If you're not prioritizing tax-advantaged accounts before taxable accounts, you're leaving massive amounts of money on the table. According to analysis from Morningstar, investors who implemented a comprehensive tax-efficient strategy outperformed investors with identical investment allocations but poor tax management by an average of 1.9 percentage points annually. The eighth and final piece of this puzzle is something Simons demonstrated through Renaissance Technologies' organizational structure, but that applies to individual investors in a different way. The relationship between systems and emotions. Simons hired mathematicians, physicists, and computer scientists to run his fund. Not MBAs from Harvard Business School. Not seasoned Wall Street traders. People who understood systems, probability, and mathematics. Why? Because he understood something profound. Emotions destroy systematic discipline, and systematic discipline is what generates consistent returns over time. According to research from Dalbar analyzing investor behavior from 1984 through 2023, the average equity fund investor earned approximately 6.8% annually, while the S&P 500 earned approximately 10.2% annually during the same period. The difference wasn't fund selection, it was behavioral. Investors bought after markets had risen, sold after markets had fallen, chased performance, and panicked during downturns. Research from Morningstar found that investor behavior reduced returns more than fees, expenses, and fund management quality combined. The eighth form of making money work for you is to create systems that remove emotional decision-making from the process entirely. For Simons, that meant computer algorithms that executed trades without human discretion. For individual investors, that means automating as much as possible and creating commitment devices that prevent emotional interference. According to research from Vanguard, investors who set up automatic contributions to retirement accounts accumulated approximately 37% more wealth over 20-year periods than investors who made manual contributions, even when both groups contributed the same total amount. Why? Because automated investors continued contributing during market downturns when emotional investors paused or reduced contributions. But systematic discipline extends beyond automation. It means writing down your investment policy, defining specific rebalancing triggers based on allocation drift rather than market conditions, and committing to those triggers regardless of how you feel about current market conditions. Research from the CFA Institute found that investors with written investment policy statements maintained their strategies during market volatility at approximately 3 times the rate of investors without written policies. Writing down your system creates psychological commitment that helps override emotional impulses during market turbulence. Now here's where all 8 pieces connect into a complete mathematical framework. Let me show you how they interlock. You engineer observation frequency to reduce emotional exposure to volatility. This allows you to separate volatility from risk and accept short-term fluctuations for long-term mathematical advantage. That acceptance allows you to minimize activity and maintain systematic discipline rather than making reactive changes. Maintaining discipline means you can replace prediction with probability and simply own diversified exposure to markets rather than trying to pick winners. Diversification reduces company-specific risk while maintaining expected returns, but only if you rebalance systematically. Your time horizon determines the mathematically optimal allocation between stocks and bonds, and longer time horizons justify higher stock allocations because probability of outperformance approaches certainty. All of this must be implemented with tax efficiency in mind, because taxes destroy compound growth. And finally, you systematize everything through automation and written policies that remove emotional decision-making from the process. Do you see how each piece enables the next piece? They're not separate strategies you can mix and match. They're interdependent components of a mathematical framework that works as a complete system. Simons proved this framework with $28 billion and 30 years of results that have less than a 0.0001% probability of occurring by chance, according to statistical analysis. But you don't need his resources or his mathematical sophistication to apply the principles he proved. According to research from Vanguard analyzing investor outcomes based on behavioral characteristics, investors who implemented this complete framework, meaning they checked accounts infrequently, accepted volatility, minimized activity, owned diversified indexes, rebalanced systematically, allocated based on time horizon, prioritized tax efficiency, and automated their systems, outperformed investors who did none of these things by an average of 5.7 percentage points annually. Over 30 years, that's the difference between comfortable retirement and generational wealth. CTA 3. If the mathematical framework I just demonstrated makes logical sense to you, hit that like button. Only about 3% of YouTube viewers actually like videos. Be part of that 3% who understands that wealth building isn't about luck, talent, or predictions. It's about understanding probability, managing behavior, and implementing systems that work regardless of what markets do in the short term. Here's what makes this framework revolutionary. It doesn't depend on you being smart, lucky, or talented. It doesn't require you to predict the future, time the market, or pick winning stocks. It doesn't ask you to beat professionals who spend 80 hours per week analyzing companies. Instead, it asks you to understand 8 mathematical principles and implement them systematically. According to research from Dimensional Fund Advisors, approximately 92% of professional money managers who try to beat the market through skill and prediction underperform simple index funds over 15-year periods. But research from Vanguard shows that approximately 88% of investors who implemented the complete behavioral framework I've outlined achieved their long-term financial goals. Think about what that means. The professionals with all their resources, experience, and sophisticated tools mostly fail to beat simple systematic approaches. Meanwhile, regular people who understand and apply mathematical principles achieve their goals at extraordinarily high rates. This isn't about intelligence or talent. This is about understanding that markets reward systematic discipline and punish emotional reactivity. Let me give you a concrete example of how this framework plays out in real numbers. According to Federal Reserve data, the median household income in the United States is approximately $75,000. Let's say someone earning that income starts investing at age 30 and commits to saving 15% annually, which is approximately $11,250 per year. If they implement the framework I've outlined, meaning they own diversified index funds, accept volatility, minimize trading, rebalance annually, prioritize tax-advantaged accounts, and ignore short-term market movements, historical data suggests they can expect approximately 9.5% average annual returns after accounting for fees and inflation. Over 35 years until age 65, that $11,250 invested annually becomes approximately $5.2 million. Now, let's consider someone with the same income and same savings rate who doesn't implement the framework. According to Dalbar research on actual investor behavior, they'll likely earn approximately 5.8% annually due to poor timing, unnecessary trading, tax inefficiency, and behavioral mistakes. Over the same 35 years, that becomes approximately $2.1 million. Same person, same income, same savings rate. The difference is $3.1 million, and that difference comes purely from understanding and implementing mathematical principles rather than depending on luck or talent. But here's where it gets even more interesting. According to research from the National Bureau of Economic Research analyzing wealth accumulation patterns, the framework I've outlined becomes more powerful over time because behavioral mistakes compound. In the first 10 years, the difference between systematic discipline and emotional reactivity might be $20,000 or $30,000. But in years 20 through 30, when portfolio values are larger and compound growth accelerates, behavioral mistakes can cost hundreds of thousands or even millions of dollars. A single panic sale during a market downturn when your portfolio has grown to $1 million can cost you $200,000 or more in permanent wealth destruction, according to Morningstar analysis of investor behavior during the 2008 financial crisis. This is why Simons's approach was revolutionary. He didn't try to be smarter than the market. He didn't try to predict what would happen next week, next month, or next year. He built systems that implemented mathematical principles regardless of what markets did in the short term. According to analysis published in the Journal of Portfolio Management, Renaissance Technologies' Medallion Fund suffered drawdowns and losing periods just like any other investment. The difference was that the system continued executing regardless of recent performance, which allowed it to capture the long-term mathematical edge. For individual investors, this translates into something beautifully simple. You don't need to be brilliant. You don't need to work on Wall Street. You don't need insider information or sophisticated tools. You need to understand 8 mathematical principles and implement them systematically regardless of how you feel about current market conditions. According to research from Vanguard, the investors who succeeded weren't the smartest or most informed. They were the most disciplined. They checked their accounts less frequently, traded less actively, maintained written investment policies, automated their contributions, and ignored financial media that encouraged reactivity.